So we were supposed to talk about gaps and micro gaps today. We will see what are gaps, we'll see what are micro gaps, and then we will see how we trade with them, right? And what are the significance of that. Something. So we know that we have an area of support or and an area of resistance, right? Let us call this as support and this is resistance, correct? Now right here, you may have a balance zone created where price is moving sideways when it has come to the resistance. And here we have a support zone right above which we have another balance zone maybe. And price may be ping-ponging right in between these two. So price is going from here. This is what price is doing maybe. And then coming up, doing some accumulation coming. So this is typical TR behavior, right? Now, in order to move out of this whole thing, you need a push from the market. And if you keep on looking at the charts, you will be able to see that push. That push may, if it's a bullish push, the push may start from here. If it's a bearish push, the push may start from here and come down. Otherwise, the bullish push may start from here and then keep going up, right? Now, what is happening in the process? In this process, the market is telling you that, okay, we are about to make a move and break out in one direction. But then remember, when you are within a trading range, even if you see a big displacement candle, even if you see a big displacement candle like this, which is not yet broken out of the trade, which may have broken out of the trading range, but with such a strong body, most of the time these gets reversed, right? So we know that strong bodies in a trading range are mostly reversed. However, what happens is it is always better to have the breakout in the form of a micro channel. That means multiple smaller bars rather than one big bar which breaks out. One big bar that breaks out, you will often see that the volume at the bottom is very less. Okay, so we may be having less volume everywhere, but this volume, in spite of this candle being so large, will be comparatively smaller, right? What does that mean? That means, so there is something called the cause and effect principle. Okay, so if there is a cause that is happening for something, the effect should be visible on the chart. Now, if that is not happening, and anything which is not in agreement with that cause is a problem on the chart. So what do we see here? We see a very small volume, but a big bar. Does that mean that bulls are strong here? No. This means bears are not participating in this area. And because bears are not participating in this area, the bulls are actually getting a free hand that even with a very small volume, it is able to create this large candle. So whenever you see something like this happening in a trading range, you know that the breakout may not be successful. However, we also know that 80% of the time it fails. So we need to see how many times it came up and got rejected. Once, twice, thrice. There is a big chance that the fourth attempt might go through, or it will fail, or the fifth attempt will go through, and it will fail, and it will break to the downside. That is also highly possible, right? So we need to see what is happening in these areas. How exactly are the breakouts happening? Right now, every candle is a breakout from its previous one. So if we have a candle like this here, and then if we have a candle like this here, this particular candle broke out of the top of this candle, right? And this is where we try to see whether gaps are getting formed, and we are trying to take support of that gap and then move out. Say, for example, if we delete everything from here and we say that the market where's the pencil? And we see that the market was moving like this, right? Now, since the market was moving like this, we suppose there is one green bar right here. So the white space means a green bar, okay? And then you see a push out of the market like this. This is another green bar. And then you see a third green bar, right? We have some wicks here. Now, in this scenario, this is forming your body gap between this candle and this candle. Okay, so this has been my setups for quite some time. I mean, in this bull run, because of in this bull run, this has been my setup in the mornings. Okay, so this is practically the 925 candle. This is bar one, and this is bar two. Okay, now this thing gets created. Maybe you will have one more, thereby giving you another gap here. Okay, however, at the start, I like to look at this gap. What happened at the 925 candle, what happened at the 930 candle, and what happened in here. Now you will see that, let us say that we do not have these ones. We do not have B2 created yet. Okay, so this is where our concentration lies. You will see that this happened even on Friday's chart. Okay, at the beginning of the day, you will see that price will come down here. Okay, it may come down below the gap and then go up and create maybe a red bar here, or it will go up and create a green bar here. Now, what is this telling you? How now we have to understand how a gap is created. If you see this candle, this particular candle B1 opened below the close of the 925 candle. So they tried to sell it first. They tried to sell it first based on this TR that we had, but they were unsuccessful and we went up. And as per price action principle, we know that we want a second bar after the B1 to be a follow through bar in order to define that we are in a kind of a trend, or the trend from the open. That's what we say, right? Now, what is happening here in this process? Bar one is a strong bar. We have created this body gap. Now the wicks came down and mitigated this body gap. Now what is happening here? Because this was a trading range, they were trying to sell here, right? And that is why we have this gap down right here between this candle and this candle. Now, since this was a trading range, some of the bears sold this candle, the top of this candle, and they were trying to get back down to the bottom of the trading range. Now they are stuck here. So this is another example where bears are stuck. We were in a trading range. We started this candle here, which was a bullish candle. The bears tried to sell, and then we posted a strong bullish candle here, thereby trapping these bears. Now, if you're willing to take a long, you will put a stop order here, right? On the other side, what can be done is you can buy around this area. Okay, considering that, okay, I have bar one, I have bar two. Why is this happening? This is happening because these bears who sold here, they now want to get relieved. Now they tried in the first attempt. Now, since this was a red bar, some of the bears tried again to break it down, could not. You may also find one candle which can come straight down here, not go below this gap area, the bottom of this gap, and the next candle will shoot up. Remember one thing: if a trend starts after retesting the gap like this, it is going to give you a swing. Okay, that is absolutely normal in, or I should not say normal. It is true 90% of the cases, which is, if you have tested all this area and you are able to still go up, this is going to give you a good swing. Now, why is this happening? This gap that the bulls created, they created for a reason, right? They wanted to go up, and you will see that you will find buyers even below this gap. Now, are they buyers or they are sellers scaling out? It can be either of them. The sellers were stuck here. When the price comes down here, they are squaring off their position and buying. So at this point of time, it may not be only buyers. The buyers may have participated in this candle, but the buyers may not have been there in this candle. Why? Why am I saying that? No, this is a red candle. Because then you see, if the buyers were really active here at this point of time, they would have actually closed this candle green, but they could not close this candle. So at this point of time, you can take a trade here. You can take a trade here, and you can put the low of bar one as your stop loss, and you can wait for this, for the first 15-minute orb or the first 30-minute orb. You can actually do that. And on these days, actually, that happens as long as the low of bar one is not taken out by another candle, or I will say, better still, you wait for the low of the 925 candle to be taken out, because that is the first breakout area. This is our first breakout area. Now, since this is the first breakout area, the bulls broke out from here. They will try to break out once again, right? The bulls will still be here. If someone has bought the top of bar one, they will try to buy again here and go back up to the top of bar one, break out of that and go, if the bulls are strong. If the bulls are not strong and we get a follow through below the close of bar one, it is highly possible that we are going to create a kind of a wedge structure, couple of legs down, and then we will see what happens if we are trying to go back again. And if there is a gap up open, they often try to come here and then go. Now see what I was saying, if this is a gap that we have and they want to come up here, this is the gap that they got created, and then when it comes down again, these bulls are present here. Now in this case, this area was what? This area was your, maybe your COI or your LOI. Okay, it is one of the points of interest, and any one of the points of interest, that it wants to close the gap there. And as soon as you see a bullish move starting out of this place, most of the time it goes, and either it goes to the 50% of the drop. Now there you will have to see what happens. Now see, this is a sudden drop, right? You gapped up and then you came down. Now once you came down, you may have come down just to mitigate this particular gap that got created here. But you will have to be careful at the halfway back line or the 50% of the whole drop, in order to see that, is this going to continue, give you another couple of legs down, and this wedge may be completed somehow this way. Why is this important? This becomes important just to see that, okay, these are not the bulls who are actually buying from here and trying to break out. They are actually the bulls who were stuck on this bar one here at open, looking at the gap up, and they are trying to come out of their position break even. At this point of time, you will have to see whether we get above the 50% line or we are rejecting the 50% line, right? It may also so happen that this was your bearish gap that got created, right? This is one bear bar, this is one bear bar, this is one bear bar, right? So this is a gap that got created, right? This is the bearish gap. Now this area may be the 50% of the whole drop. It comes in here, or even it goes back up here. Find sellers in this area again and then drops. That is why I say that if you have this, say this is a bearish gap, and if you have a bull candle closing above the open of this gap is still not closed. I need a follow through bar to say that this gap is closed, so that this will say that, okay, the bears here are actually getting weaker. So I'll just quickly explain what ORB is. So a 15-minute ORB is a 15-minute opening range breakout. So which means if these are my first 15-minute bars, the first 3 5-minute bars, or this is my bullish 15-minute, this is my bullish 15-minute bar, this is 15 and this is 5, then if you buy here, the probability is that it will duplicate this range on the top, giving you a measured move. This is what a 15-minute breakout looks like. This is called the 15-minute ORB. Okay, once your 15-minute ORB is reached and you still see upside in the market, then you go and see, okay, this is my 30-minute bar right now. If the market wants to do a double of this, it will get up to another 30-minute bar, or maybe it may take 35 minutes as well, right? But this becomes your 30 minutes ORB at that point of time. So this is the ORB entry, and this is the ORB measured move. You can take some profit here, hold on to your runners, or you can come out of the whole trade right here because you have got your 1:1. So now again, getting back to the gaps. So this is one gap strategy, right? That you are buying right in this area at the bottom of the gap, and this way you are actually minimizing your stop loss, right? If you have bought here and this candle right here had a wick, now the bulls are trapped. But looking at this bottom, you are now kind of sure that okay, the bulls will actually try to break at least break even or break out from here. So that is what this is telling me. As long as a candle does not close below this gap area, I am not bothered. Okay, so this is not bothering me. This area is not bothering me. This pullback is not bothering me. I can buy here. Even you can buy outside this. But if you see that this bar has closed below this area, now it is the time to be careful. That okay, I will come out of the trade. Maybe below bar one was your actual stop loss. You will put your regular stop loss right here, a couple of points below the strong close of this bar, because the strong close of this bar outside this area may signify that the bears are becoming stronger. But on a super bullish day, what you will see is we will see a double bottom here. It will not hit your SL. Remember, your actual SL was here. When you are trying to get your SL up, you put it a cup 1 point or 1.5 point or 2 point below this, in order to see that okay, if the bulls are still present here, they may very well trap the bears. If this is the bearish bar, they may very well trap the bears by a couple of ticks, go back and close this, or even do a perfect double bottom at here, and then keep going up again. So as long as you do not have a follow through to a body that has closed below the body gap, you do not, your body gap is actually not closed. Okay, this has been my observation, because if it goes back from here, that means I still have I still have bulls here looking to break out. I still have bulls here who do not want to give up on this trade, and they want to take the market higher. Now, on the downside, see, this is a bull bar, this is a bear bar. Now, this closed on its low. Another candle closing on its low, okay, below the low of bar one, is telling you that okay, the market may be going into always in short. You will short below this, but then you will keep an eye on this gap that happened. Now if you feel that the gap is too big, or it is not in this candle is not a very strong bearish candle, at that point of time, what you will have to do is you will have to wait and see if this gap area is getting retested and we are closing below bar one again, right? We are retesting this gap and we are closing below bar one again. That is the best place to take your short trade, and then look for a 1:1 or a 15 minutes ORB on the downside, or a 30 minutes ORB on the downside. Correct? Now, if you see that after this move, a channel is getting formed, not like this, a channel is getting formed, and most of the time, this channel has an angle of 30 degree. This is the trend channel. This is the trend line that got formed, right? And if you see the angle that we get here is less than 30 degrees. Okay, in most of the cases, if you see something like this, as long as we do not get a breakout of the bottom trend line, you will mostly see that price is doing it's kind of a trading range with a inclined slope to the downside, right? So it has an inclined slope, but you are not seeing continuous big bear bars. This is already telling you that this trend may not continue for long. It may get a breakout, it may create a wedge, and immediately it will start turning back up after that. Now you will have to keep an eye that okay, this thing broke out, we came back in, we know that it's a wedge breakout failure and it wants to go back up. However, be again careful in this area. See if the price is actually going up. It may so happen that we have created a gap right here. Price comes and tests this and then goes back up again. So as we are coming up, we need to see that, okay, this is actually, where is the channel? This actually is breaking out of here. We are getting here. Okay.
Just a couple of questions.
Yeah, go ahead.
So I think the strategy that you're currently talking about, it's the start of the day strategy, right? How do you start the day?
Okay. Yeah, go ahead. Go ahead. Finish your question, then I'll talk.
Yeah. So I do understand the way you're talking about the ranges and everything, but I mean, if you're looking at the first bar, is that where we need to like be concentrated how we start the day, or is like generally any time around?
No. So when you are looking for, you will look for these gaps that are getting created at the beginning of the day, right? That is number one. You have to look for that. First, you'll have to look for gaps between, this is what I do, gaps between COY and OOD. Okay. If this gap, COY is close of yesterday, OOD is open of the day. If this gap is too big and the EMA is here, do not buy right here. This is your OOD. Do not buy right here. Most of the time, what happens, this may be the 50% area of this gap. Price may come down here and bounce. Price may come down here and bounce. Okay. But when you are going long, do not go long when you have a 30-point gap or a 20-point gap or even a 15-point gap from the EMA. Right now, it is highly possible that it will hold this here. It will come down here again to the open of the day and bounce from here until and unless the EOD is, and it may keep the gap to the EOD open. But then you need to look at this setup. Okay. So if in this kind of a scenario, most of the time what price does is, either if this previous day has been a strong bull day and has moved about 90 to 100, 80, 90, 100 points, at this point of time price will just do this here, as long as it does not catch up with the EMA. After that happens, and this has been the high of the day prior to that, prior to the EMA touch, or maybe a little EMA gap here. When this breaks out, now you will have to see that, okay, was a gap created? Did I get a micro channel? Were there enough touches here for me to break out now and then take the trade here? It is always prudent that you see that, okay, this is breaking out, this is breaking out, there may be a pullback, and then it breaks out again. Okay, now based on this pullback breakout strategy, there is one wonderful way to play this, which is, if say you are in an upward channel, right? Or no, I won't say upward channel, say you are in a downward channel or expanding triangle or whatever it is. This is that upper trend line. What happens is, we break out of this strong, and then we break out of this again. Maybe this is the second time the price is trying to break out. You do not buy here. Please do not buy here. If this is just the second time that the price is trying to break out, do not buy here. Price will come and retrace this move, right? Once that is done, you get another bar which closes above this pullback bar. Okay, this was breakout, pullback, regain, right? Breakout, pullback, regain. You may have your body gap right here at this. You will need to keep an eye on that. Now if you see that this has, and it is better if it goes deeper into the body gap, and then we find this, you buy here. Now you buy here, and you look at what was this leg, and you try to get a 1:1 of this leg. So this is how you trade a breakout pullback. If it's the second or third attempt to break out of this channel, okay, make sure you are not missing out on this. Do not put your buy order immediately here. Let this candle go down. If you want, if you're sure that, if you're thinking that this candle is just retesting, it's just a pullback, you can buy as low as possible at the bottom of the gap, thereby reducing your stop loss significantly. And as the market goes up here, it closes another candle, you can buy one more contract, get out of one at maybe a 1:1 of this candle, and hold the other one for the final retest of this whole legs measured move. Making sense? How to combine gaps with different other things. So gaps are very important. Okay. Yeah, someone was saying something.
Suppose the third example that you gave, like that bearish part, right,
Yep,
where the
yep.
pullback happened, right?
Mhm.
So while we are in the bearish part, right, we do not know that it's gonna be trending in the same channel or it's gonna break out again or regain again, right? We
Correct.
don't know that, right? So at
Correct.
this point in time, we cannot take any position, long or short either.
See, if this is the second time that we are trying to break out, okay, you can actually short here. Your stop loss is very small. Your stop loss in this case is very small. Okay, but better is now this is a trading range as well, correct? So what is a channel? A channel is a trading range with an incline. Now, based on the angle of the incline, we can sometimes say that whether this is going to be a strong channel, it's going to keep on going down, or it not, right? So if this is the, and we know that 80% of the time these breakouts will fail. So we count: one, fail; second, two, fail; third, three, fail. Now we come down and go out for the fourth time. This is when we need to try and see if we get a breakdown here as well, we will come down again. Now this is giving you, what is this giving you? This is giving you first entry short. We do not enter first entry short, specifically because there has been a breakout. Wait for a second entry short, and that second entry short will actually bring you down here. So what will happen is, you got your bullish candle here, you got another bullish candle here, this was your channel, you came down and you go, hold on, you have your first bullish candle here, you have your second bullish candle here, this is your breakout line. Now this bar comes here, here is where you have your gap, this bar comes here, it tests it, okay, it can go back up again. Why? People bought the close of this, but it has not gone and closed above the top of this red bar. If it does, that's my buy setup. But if I get another bear bar here again with a wick like this was my first entry short, leg down, leg up, and leg down again, second entry short, you will enter your short position right here with a stop order. Now, it may so happen that right after this breakout, this bar, say we had this bar comes down to the bottom of this area. This is a big surprise bar. Okay, there are two chances. Bulls will buy here again, get to the 50% of this bar, of the surprise bar, and try to break even, and then you will see we are coming down. Or they will try to go back up to the top here, because remember, this is a trading range and we have buyers in this area. They will try to get back up to the top here, and then price may reject again. If this kind of a move has happened, that means there will be bears again sitting in this area, and when price comes here, you will see. And also notice the gap that you have here. If we have a 20-30 point move down in this direction, once the price goes up here, it will again try to come down at least halfway. And this is how the trading range gets created, right? So if this is a strong move from here and it creates an order block in this area, the last order block which started this crazy move down will still have some sellers here again who will try to sell it down. Then we'll have to see, are the buyers strong here and are they trying to get the market up? Yes, then okay, we are confirmed now that we are in a trading range. We will have to see how many touches happened on the top, how many touches happened at the bottom, how many bars happened over this whole time frame, what is that, how long this whole trading range has been, and based on that you will take your decision on how to trade or which direction to trade.
So Bhuj, in terms of the close of yesterday, right? If the
Mhm.
the gap is too much, right? Let's say that the opening of today's the opening of the day was, let's say, quite a lot of points ahead, like above the previous one, right? So the
So you are
probability of,
saying this is COY
yeah,
and this is where we open, and say we have a 26-point difference in between.
yeah. So so we will do consider about like how the trend is going, how the gap
Okay,
is
some
versus everything.
some major principles based on price action. Okay, number one, if your gap up is too big, if gap up or gap down is too big, there are two possibilities. It will create a TR at the open, TR at open for maybe 1 to 2 hours. The 20 EMA will catch up with the price, and then we will see which direction the market moves. Okay. The other possibility is it starts with a trend from the open, trend from open. How will we see that? Two strong bear bars closing at their low, which is between the 50 and the 33% or lower. Okay, so this is defining the trend from the open on the downside. Now, what is our target? If we are shorting this, what is our target? Our first target becomes the 50% of this gap. This is our first target. Because think of it, even though it's an opening gap, our futures is a continuous market, right? So think of it as a strong bull bar right here, and there were bears who were here. We were trying to come down here, relieve the bears, get back up from here again, break the open of the day, and do a 1:1 of this. This is one possibility. Number one. Number two is this move can actually bring you down to the COI and then bounce from there and then get above this 50% line and then go to the top again. In this whole process, remember that this 50% line becomes very important to define whether the bulls are trying to create a trading range, or either a trading range, or they want to break out of the open of the day, go above the bar one high and then continue higher, or this was just an attempt for the bulls to come break even. The bears take it up here again, and then we will see whether we have a double bottom here, whether we have a lower low double bottom here, and then the price comes back again here, again the 50% line. Now, if this keeps on happening, we know there's a trading range. And at the end of the day, what happens is, if this is what has been happening, and there has been a little trading range here at the top, at the end of the day, most of the time, it breaks out of this 50% area and goes and closes your day right here. This becomes your COD, close of the day, thereby creating a doji bar. This is highly possible. Now, there are two time frames on the daily, right? So when we look at the daily chart, we look at the ETA chart, right? Which is from one day to the other. There is one more way to look at it. That is number one. Go to your 5-minute chart. Go to 5 minutes. Number two, change to RTH. Change to RTH, and then number three, look at 24 hours time frame. Okay, 24 hours time frame. Now, what is this 24-hour time frame? This is giving you the RTH daily. That is the 9:30 open, 4:15 close, high and low of that time frame. It is not giving you the ETH daily. The 24-hour is giving you the RTH daily. So it becomes easier if you keep an eye on this, because then your COI, LOI, HOI, or OOI, all these are in your 24-hour time frame. Okay, so at that, if you just want to look at RTH, this is what you can do. On Ninja, if you want to look at the 24-hour time frame, add 1443 minutes as one of your time frames on your chart, and then look at the 1443 minutes, and that will give you this particular time frame that you see on TradingView. Now on here, on Ninja, again, many people are confused what exact data series to use in order to get the ETH and the RTH. So from a Ninja data series perspective, what I use is CBOE US Index Futures, Index US Futures, ETH or RTH. So this ETH will give you the continuous market, RTH will give you only the New York session. So CBOE, US Index Futures, ETH or RTH. This is the data series that you need to select on Ninja. This for the ETH chart, this for the RTH chart. Now, what happens here? We talked about the first two options. TR at open, 1 to 2 hours, 20 EMA. The price touches, and then we see what happens. Otherwise, we have a trend from the open. Two strong bear bars closing at their low, and then our target is 50% of the gap or close of the gap. Correct. Now, if you see that we are bouncing from this area, which is the COI, you know that it is the same thing. Can I create another control? So you will see that this was your COI here. We had your displacement candle, and then you had another bar, thereby creating your body gap. This is your ETH gap, or this is your GX high, and this is your GX low. We come down here, and that is why during a gap up, GX low becomes so important, and we start bouncing from here. This is where we know that, okay, this was the gap fill up trade, and now we are pulling back. We are trying to get to the top of the gap, or at least the 50% of the gap, and then if the gap breaks out, we will get a 1:1 of this. Exact same thing happened on Friday. Okay, so on Friday, 85 was the bottom, 5585. On the top, we had 5605, okay, which was the news bar high. This was the news bar high. What we did was, first, we crossed above this. This was 20 points. We first came to 15. That was the first stop, 10 points from here. Then we went back to 20. So this was, if you remember, I was saying that we will get to 5514, and if 5514 crosses, 5520 is our next target. So we got this 5514, which was 50% of this whole move, and then we moved to 5520. Sorry, 5525. That's it, right? 85 to 05 is 20 points. 05 to 25 is 20 points. So we got this here around the 1514 area, and then we moved up to the 20 area. In the middle, I was a bit cautious because we have to be a bit cautious, right? That it is moving so much. We have moved so much high. The market is overstretched under any circumstances. Whichever time frame you look at, the market is overstretched. Okay, so this is what is happening. So we broke out of this trading range, and we doubled this range up. This was 20 points. We got another 20 points. So that was the idea, right? We were not expecting that on Friday, after 2 days of holidays, people will come and start putting in big trades and try to get to the top. But think about it. Even with very low volume that we are having on the daily chart, we are able to create a new all-time high. Now, what is this telling you? A new bar, a small volume is creating an all-time high, creating a breakout and staying above that breakout area. Even if you remember, 5507 was one of our measured moves. If you look at the chart, we broke out, we came back down and bounced exactly at 5507 before we went back up to 551415 area. Okay, so this was the breakout at that point of time. So we broke out of 5507, we came back, retested, we closed above this high. This is a good buy spot to get to the next level.
So Saluj, this is like on Friday, right? 5th of July.
Yeah.
4th was holiday, right? So the trading would be low on 5th, definitely, right?
Correct. So a 3rd was half day, 4th was a holiday.
Yeah, and when the people will come back on Monday, right?
It will still be a bit slow. Again, you are coming into the market after Wednesday, Thursday, Friday, 3 days of almost half volume action or no action.
Yeah. So in
Correct?
that case, the correction might be happening as well. That's also possible.
Correction might be happening. We are almost at the, if you want to see here, let me show this to you. Now we need to break out of our 5655 level, which is already a target. You remember 5632240 is our first target. We hit that. We go. If you see that 5655 is rejecting, you know why it is rejecting now, because we have this wedge formation right here. Apart from that, let's see if we have any other wedges. This is the other wedge that we broke out. Now we broke out, pull back. This is the trade, right? Control Z. Breakout, pull back, and then it moves in the same direction. This was 1 week of downtime, right? This was actually the pullback after this breakout. Now, if you are saying that, okay, where will we go? Since this was the breakout candle, we can actually come to this 576. It's highly possible now. There may be multiple other wedges here as well. There may be a wedge right here. So even if we come down a little bit, it will go back up to hit this line. So these are the different areas that we need to incrementally add to the chart to see where it can get stuck next. Now, if this 5600 is this 5650, 5655 area is taken out, we can easily come to 5700 and then 5766. On the monthly chart, we do have several other different areas where price can go and test on the top. There are multiple measured moves. Now, if you see here, this was a gap, correct? This was a gap that got created. Again, between this candle and this candle, this was another gap that got created. Now, this was my pullback. Based on this pullback, this was my breakout, correct? This was my breakout. If I want a 1:1 of this pullback, because see, we started buying right here. If we want a 1:1 of this pullback, we can very easily go up to 5716. So these are the different lines, and these are the different ways how we keep this in mind. If you see one more thing on the weekly chart, if this was my first move, this was my second move, and this is my third leg that is going on right now. Yeah, kind of. If this was my first leg, this was, no, this is not the first leg. This should be the first leg. Yeah. If this is my first leg, my second leg's turn is here, right? If I say that, okay, let's not consider the smaller ones. Let's consider only, because these have not created any lower lows, right? The lows are still higher than the previous lows. Here also, we did not create a lower low. So I am considering that this is one move. This is the other move. Now, did we come below this? No, we did not. So this is, we are still in this move. So it is highly possible that this line, this 5739, 5740 is a target for the weekly bulls. And standing here from 21 to the next 139, that's around 100 points. It's easily achievable, right? And then see what happened during the breakout. During the breakout, what did we do? We created one more body gap right here. We created one more body gap right here. And see, it got tested exactly till that point, and we started bouncing from there. Now you get the idea of how to use the body gaps. Now this is a buy the close candle. This is absolutely a buy the close candle. And if this is a buy the close candle, and if it wants to go up that 100 points, it can easily go up that 100 points. The other thing that is concerning me is this is the second standard deviation of the EMA, right? So this is my version of the Bollinger Band. This is the second standard deviation. So if you look at the Bollinger Band here, the Bollinger Band is somewhere like this. So this is 2.5, but my 2.5 is a little bit less than what the actual Bollinger Band shows. So I normally use this EMA standard deviation rather than, because if you see here, this is what I was telling you the other day. The source of this is based on your SMA, right? This is your SMA, and based on the SMA, you are deciding on the 2.5 thing. But it is almost the same. But since I use 20 EMA and not 20 SMA, I stick to this one. Okay, so we are above this now. So there is a possibility it goes up, touches this line, and it will get to the 2.5 line of this, between this 3 and this 2 standard deviation, and we may actually get a pullback back to this area. So it is possible, right? But we have to see what are the major areas that have been taken out. Like for example, 85 is a very strong area of support at this point, 5585. The price may come down, retest 5585, and will start going back from there again, create the next leg up. So anything is possible. So this is what I'm saying, that are the gaps and the micro gaps. These are the body gaps, that how we look at them. Now, what are micro gaps? Micro gaps normally, you look at it in the 5 minute chart. When you are in a trend, let's see. One of my students actually created indicator. So this will give you the micro gaps and the double bottoms and the double tops. It is there in the server under the PA indicators tab. Okay. So if you see here, when you are in a trend, these are your support, right? These form your support areas. Look here, we created this micro gap, we came down here and we bounced right off of that. Okay, now look at this. Two consecutive micro gaps in very close vicinity is giving you a better idea that, okay, the price has still opportunity to go up. Now, these micro gaps are getting drawn automatically. It will get erased also by itself. These two are how the gaps are getting formed. And this is telling you that, okay, this is going to be a good move up. We are already in an up move and we are creating micro gaps. When does this micro gaps get away from your chart or gets erased? That happens only when there are two closes below the micro gap or two closes above a bearish micro gap. So you remember, in the same way we were talking about how a body gap gets closed, we have to close below that, and then we see that there is an absence of bulls below that micro gap, and we created another bar below the micro gap. Then we will get rid of that micro gap from the chart. Till that point of time, as the day progresses, this micro gap will also start
Because
getting
those
extended.
micro gaps will not have any significance, right?
Correct. Correct. Okay, so this is how we treat gaps and micro gaps. In a trend or at the beginning of a trend, micro gaps are very common. If you see the candle came below the micro gap and then posted a strong bar up, maybe that is the beginning of it. But then we will keep in mind that a micro gap has formed, but we are still not going to take a trade based on the first entry long. We will still wait for the second entry long. We will still wait for a close above the first entry long and then take the trade. So what I'm saying is, sometimes after a protracted move to the downside, if you have a protracted move to the downside like this, let me mark it as red, and then this gets your H1, and then we come down, this gives your H2. If you are taking a trade here, it is better to wait and see that if we are having a change of character above this and you buy above this area, this is a much higher probability trade compared to taking the trade here. Yes, H1, H2 logic. If you see strong candles, you can enter here, especially because there may be a gap that has formed right here, and we tested the gap and we are trying to go up. But then remember, we were in this kind of a move. Market may want to come back here and get down here again, and this may be just a wick above this H1. So you need to be careful in this area. This may actually create a double top here and then give you another leg down from here, right? Even though if this is a wedge, the break of this bottom will be the wedge failure, right? The wedge did not hold, the wedge failed, and we are mostly going to get a measured move of this length. If this is the length, we are going to get a measured move of this length below this. Okay, so this is how we look at H1s and H2s after a protracted move down, say 20, 30, 40, 50 points, because there is a very high possibility at this point of time, there is a very high possibility that the market will keep doing this. Okay, so be very careful in this area when you are taking when you are trying to take a trade on the first H1, H2. Most of the time this happens. Now what will happen here is, maybe at the end of the day, or you remember bar 40 to 55 is the turning point. Between that time you will see a bar like this. Okay, now this is where your gap gets created. You can enter on top of this, this may be a very big stop loss for you, but at this is the point where I keep my money stop loss. Or if I see that, if I have my stop order here and I see it coming back to the top of this trading range here, I will buy at the top of this trading range and see, and if it closes below the trading range, I'll be out, because in this area I have not taken any trade, right? So keep an eye between 1245, which is bar number 40, to bar number 50, 50 to 52. That is when the major reversal happens, right? If you have been in a trading range, that is when it will break out. If you are in a TTR, that is when it may break out. If you have been coming down, that is the point of time where you will see a strong reversal and market will go and get to this 50% or at the top again.
So that means like at this point in time in the center, right, in the mid time, right? So we have to take, in this case, long, right, without even waiting for the next bar.
You can take a long here, because after such a move, and especially if you have 2 3 small bodies here. Now, why I'm saying you will not need a follow through out of this, because this was your trading range, and this actually pushed pretty far out of the trading range. Okay, but this is a buy signal, and especially look at the time of the day. We know that this is the time when the reversal occurs, so you will have to take the trade at that point of time. If you sit here and the trade comes back to this 50% line, and then you are saying, okay, it reached the 50% line, let me get long, you will lose out on that, because it may actually come down and do another 50% to the bottom side if it wants to do. So your first target is always the 50% area. Why? Because bulls might have bought here, they are trying to get out break even. Correct? Bears might have, if it's a reverse case, bears might have sold here and they want to get out break even. And that is when you see that these wicks are formed at the middle of the day. We also have the indicator of the mid range of the day of the intraday trading. If you put it on the RTA chart, you will get a line like this. This is also in the PA indicators tab. Now, one more thing is, why was I saying that if you have something like this, wait for this stop to be taken out, right? Because during this process, you might have created a bearish gap here, correct? Now, if you have come out of the trade, of the long trade here, now there's a bearish gap. So let me mark it as a red box. Now, as long as you do not go above this gap area, the body gap of the bearish area, and you do not go above this high, you are not sure that whether a change of character or a break of structure is going to happen. Okay, I will stop it here today, and I'll see you guys soon. Bye.